Good afternoon, everyone. Robert Rayburn here from Life Pro Asset Management. Hope that everyone's had a great week so far, despite some of the up and downs that the stock market has been throwing at us. And hopefully everyone has some great plans for the weekend. Certainly it's a rest that is well deserved. But what we're going to focus on today is exactly what we just alluded to, which was some of that up and down chop that we continue to experience here in the month of September. It's quite typical. If we think of Septembers in the past, we get a lot of this up-down action. Historically speaking, September tends to have around a flat overall historical performance. Why is that? A lot of the times people are just repositioning portfolios for year end, and that kind of exudes itself as seasonal weakness. But in this year's case, what we're going to go and look through is some of the market positioning that we're seeing in the overall market. We also want to take a look at what did the Federal Reserve say. So we saw some selling after the Federal Reserve came out with its testimony. That is a classic buy rumor, sell the news type of short-term trading strategy that doesn't really impact our portfolios. What we're more concerned about is the substance of what they said and how does that impact how we should look at long-term asset allocation. And then lastly, what we want to understand is where are we in the recovery? Is it too late to invest? And certainly if you've read our prior weekly updates, we believe based on our research, based on historical analysis, we are in the early innings of this recovery. And a lot of the volatility that we've seen here in the last couple of weeks is very similar to what we saw back in May, through some of the weeks in July and in June, and is very healthy. You want to see that. You do not want to see, despite our wantingness to see it, we don't want to see the market going up every day. That's what creates long-term froth and can create instability that is more structural than temporary. So overall, things look very healthy, but we're going to go through all the numbers today. In terms of performance, despite that volatility, the overall drawdown has been quite shallow. In fact, we've actually been able to expand our outperformance over the last few weeks. And so we can see here in 2020, the opportunity strategy remains up around 54.65%, despite the fact that the S&P 500 is almost back to break even for the year. So we're definitely happy with those numbers. When we look all the way to inception back in 2017, we are up 152% versus just shy of 50% for the S&P 500. In other words, we've been able to generate outperformance of just over 102% after fees. So we are happy with that. Longer term, it's important that we remain vigilant, not just to the downside, but what are some of those other opportunities that are arising as this market recovery continues to progress forward. We're going to talk a little bit about that today. This was the slide that we showed last week. It just really here shows how early we are in the recovery and how similar this recovery is to 2009. Almost tick for tick, exactly the same sort of path that we saw off the March bottom in 2009. We're following that tick for tick here in 2020. And of course, what happened 6 years, 7 years, 8 years after the first 7 months, the first 6 months of the 2009 recovery? We had a long-term bull market. We believe that in 2009, a new 20-year bull market started. And what we saw in March of this year is analogous to the 1988 or the 1987 sell-off in the stock market. And now we're seeing sort of the second stage of that 20-year bull market move beginning, and which started in March of this year. So again, the consensus is bearish, the positioning is bearish. We want to take the other side of that investment. Now, in terms of the overall FOMC policy statement, which stands for Federal Reserve, interest rates are going to be low for a very, very long time. That was the basic message. So when we look at the actual numbers that were released by the Federal Reserve, there is something called the dot plot, and it's what different FOMC members expect interest rate policy to be if unemployment reaches a certain level. And what we noticed here is if we look very carefully, we have to squint our eyes here, but in 2023, if unemployment reaches 4%, the members of the Federal Reserve expect the federal funds rate to be at 0.1%. That is incredible. So in other words, we can see here 8.4% unemployment. If we go all the way back down to 4%, that means the Federal Reserve is still not going to move on interest rates. Is this a promise that's held legally? Of course not. They can change their minds. But as of now, the messaging by the Federal Reserve is that interest rates are going to stay low, near zero, for a very, very long time. What does that mean for you? What does that mean for myself and our families? That simply means that when interest rates stay low for a very long time, that tends to be positive for asset prices, whether that's stocks, whether that's real estate. It just tends to be very positive because it gives a lower cost of capital for people that want to borrow money, and that tends to be a positive attribute for overall economic growth. The other thing, of course, we're seeing is liquidity remains abundant. When we look at that money supply growth line, it is just absolutely soaring, far above what we saw in 2008. And now we're starting to see positive revisions come in for forward earnings estimates as we get into 2021. We've been talking about this. We've been pounding the table that earnings estimates are too low for 2021. You want to invest ahead of that, and then you're going to see those estimates come up. That's exactly what we're seeing. The next stage to this stock market recovery is going to be in 2021 when realized earnings start to go from being theoretical to actually cash in the bank for these companies. So that's typically how recoveries work. Multiple expansion on anticipation of an earnings recovery that catch a lot of people off guard. The second stage is the actual earnings recovery itself. That forces people who are short the market to cover their shorts, forces more people back into the market, and pushes stock prices higher. The other thing, of course, is positioning. We talked about sentiment being bearish, but actual investor positioning remains bearish. Now, S&P 500 positioning in the futures market has been bearish for a long time, in other words, net short. One thing we have noticed here over the last couple of weeks is that the NASDAQ, believe it or not, is now in a net short position. When we look over the last decade, almost every single time that the NASDAQ went net short, it was close to or right at a market bottom. So not that this sell-off has been that deep at all. Really at the end of the day, we're talking a common 5 to 10% correction, but we are seeing those loose hands being shuck loose, and that historically speaking, when this goes net negative, net short, that is usually a good time to start picking away. And that's exactly what we've been starting to do, starting to look at where are there some opportunities that we're not positioned right now. And then, of course, there's been a lot of positive symptoms in the overall stock market. When we look at what's actually outperforming, these are not attributes that tend to exhibit outperformance ahead of a recession, ahead of a big sell-off, ahead of heightened volatility. So if we look at copper's outperforming gold, that is a classic exhibition of positive sentiment around an economic recovery. Copper is used to build things. Gold is used for safety. When we look at materials, so like chemical stocks, the materials, machinery, miners, they are outperforming the S&P 500. Consumer discretionary stocks, so in other words, if we think of large purchases such as Apple products or cars, etc., they're outperforming consumer staples, stuff like if we look at stuff we buy in the supermarket, we have to buy it no matter what, recession or not. So a lot of these things, high beta versus low beta, a lot of these attributes are outperforming, which tells us, again, increases our confidence factor that this shallow sell-off that we've seen here in September is typically normal. It's a symptom of the market catching its breath, and underneath the surface, things are continuing to improve, and you can see that in the copper chart here on the right. One interesting thing that we have started to notice in the bond market. Now, we have not bought any of these stocks. This is not a recommendation to go buy these stocks. What this is a first indication that the center of the COVID storm stocks, in other words, the scene of the accident stocks, might be starting to position themselves for a recovery. When we look at the different companies right now that are focused on developing a coronavirus vaccine, right now there's about 5 that are in phase 3 and 1 that's in phase 2. Will some fail? Likely. Will all fail? Very unlikely. And so when you're in phase 3 data and you're pushing toward final approval the way the government is right now, there is some signs here that this is real. This is going to happen, which would signal some sort of economic reopening at a greater and more sustainable scale than we've already seen. What's interesting is that the sentiment is starting to be picked up in the bond market. So credit spreads, we always talk about those credit risk spreads that we see in the bond market. We want to see those lower. In other words, credit risk is falling. We've started to see that across the cruise liners and across the airliners and the casino operators. Across the board, those credit risk premium spreads are starting to come in. That tends to, during these types of situations, happen ahead of the stock move itself. So again, we're paying close attention to it. This is a potential opportunity for the portfolios, but this kind of shows sort of how we identify ideas before we actually execute on a trade. And of course, we see that credit recovery taking place across the board. This is the high yield credit spreads, again, continuing to recover, gives us more and more confidence that there is a recovery taking hold, and that it's sustainable. So overall, this is an orderly market consolidation. Even the sellout, the weekdays we saw this week were very orderly. There was not people rushing out the doors or anything like that when we look at overall investor flows. It was very orderly, which tells us this is very healthy. Low interest rates are here to stay for a very long time. Position portfolios in assets that historically benefit from that type of positioning. And then, of course, investor positioning remains bearish. You want to be a contrarian. That is a bullish setup for asset prices going forward. And last, but certainly not least, the economic recovery does in fact remain intact. So if anyone has any questions whatsoever, please feel free to give us a call. Our number is 888-543-3776, or you can call me on my cell phone at 858-354-5114. Thank you again and have a fantastic weekend.